You and the guy you sat next to in college start jobs the same week. Same age, 31. You both put $10,000 into a 401k on the same Tuesday afternoon. You both pick the boring option, the total stock market index fund, the one every finance channel on earth tells you to pick. You both never touch it again for 35 years. Same fund, same market, same crashes, same discipline. He ends up with about $104,000. You end up with 75. $29,000 gone. You didn't panic sell. You didn't chase a meme stock. You didn't do one single thing wrong. You took a job at a company with 41 people, and he took one at a company with 30,000. That's it. That's the entire crime. And nobody at any point told you that was a financial decision. That gap isn't a mistake. It's a design feature. And it's the smallest one I'm going to show you today. My name is Nick, and I spend an unreasonable share of my life reading fee disclosure documents so that you don't have to. If you have ever done everything right with money and still felt like you were running uphill, hit subscribe, because today we are pulling apart the 4 layers of this system that quietly decide how much of the market's return you are actually allowed to keep. He gets a name because we're following him for the next 20 minutes. Jonathan, hospital system, 30,000 employees, same index fund, better deal. You get the dental supply company, 41 coworkers, and a laminated benefits folder somebody handed you on day 1 that you have opened exactly twice. Here's the thing nobody says out loud. Almost every investing video you have ever watched is about the one variable you control. Which fund, which stock, which allocation. That's fine, that's the easy part. That's the part you can figure out in about 9 minutes. What almost nobody covers is everything sitting around that decision. The plan you got handed on your first day, the app your money lives inside, what the index quietly became while you weren't looking, and the door you are legally not allowed to walk through. And somewhere in the back third, a third person shows up. Preston, also 31, he's going to make the entire you versus Jonathan argument look like 2 people fighting over the dinner check while somebody else quietly walks out with the restaurant. We'll get there. Let's start with the layer that already cost you $29,000. So when you take a job, you get a 401k. You don't shop for it. You don't negotiate it. You never even saw the sales pitch. Your employer picked an administrator before you were hired in a conference room you will never stand in, and that choice now applies to every dollar you save for the next 4 decades. According to the 401k Averages book, a small plan holding around $5 million pays about 1.1% a year in total costs. A plan holding $50 million pays about 0.8%. And a really large plan, the kind with a proper low-cost index menu, gets you under 0.1%. Same market, same fund names, half the time. Different price tag, based entirely on how many coworkers you happen to have. And the reason is almost boringly mundane. Somebody has to pay the record keeper, the auditor, the compliance people, the advisor. At Jonathan's plan, you split that bill across thousands of employees. At yours, across 41. Nobody is twirling a mustache here. The math is just the math. The math simply happens to land on you. Now, 1% sounds like a rounding error. It is not a rounding error. It is the single most expensive sounding cheap number in all of personal finance. Run it on a real savings rate instead of a lump sum. $6,000 a year, 35 years, 7% gross. In Jonathan's plan, you would finish with about $815,000. In yours, $656,000, $159,000. Let me say that again, because it's the same fund. $159,000 for the identical fund in the identical market across 35 identical years of you not flinching. That is a paid-off house in most of this country. Or, if you would like to feel considerably worse about it, it is roughly 90 years of the median American's entire monthly retirement income. I'll explain that number later, and you are not going to enjoy it. Now, I want to be genuinely fair here, because this whole video falls apart if I'm not. Fees have collapsed. That's real, and it's one of the great underrated wins for regular people. Morningstar tracks the average expense ratio across every US fund, weighted by where the money actually sits. And it fell to about a third of a percent in 2024, down from more than 4/5% in 2005. That drift alone saved investors nearly $6 billion in a single year. If you had told a mutual fund salesman in 1995 that you'd one day own the entire American stock market for 3 basis points and pay nothing to trade it, he'd have laughed you out of the building. So, yes, the fee war happened and you won it. Which raises a slightly uncomfortable question. If nobody is making money on your fund anymore, how is the app on your phone one of the most profitable businesses in the country? The answer is that the fee didn't disappear, it just stopped looking like a fee. Start with the trade itself. When you tap buy on a commission-free app, your order usually never reaches a stock exchange, it gets sold. A wholesale market maker pays your broker for the right to fill your order, then fills it in-house. This is called payment for order flow, and per the Congressional Research Service, the 12th largest U.S. Brokerages collected about $3.8 billion from it in 2021. Robinhood alone took roughly $974 million. Call it half the company. The per trade number is where it gets funny. Robinhood disclosed earning around 0.2 of 1 penny per share. 0.2 of a penny. That is not a fee, that is a rounding error with a business plan. It only becomes billions when you do it a few 100 million times to people who have been told the product is free. In fairness, the defense isn't nothing. Market makers all pay roughly the same rate, and competition between them does deliver real price improvement on plenty of orders. It's also true that in 2020, the SEC fined Robinhood $65 million over orders where the price difference ran as high as $15. Then there's your cash. And Jonathan, by the way, has had about $4,000 sitting uninvested since March because he keeps meaning to get around to it. That cash is working extremely hard right now, just not for Jonathan. Whatever sits idle in your account gets swept into a partner bank. The bank earns interest, you get some of it. In 2024 and 2025, a wave of class actions hit Schwab, Morgan Stanley, LPL, Ameriprise, and Merrill over precisely this. One complaint alleges Morgan Stanley earned roughly $8 billion in a single year on swept customer cash, while paying some customers as little as 0.01%. Schwab was paying under 0.5%, while the Fed funds rate sat above 5%. Congratulations, you thought you were an investor, you're a depositor. And here's the detail that reframes the entire industry. In 2024, Robinhood earned about $1.1 billion in net interest income. That is more than it earned from trading. The trading app's largest business is not trading. It is your sleeping money. Nobody lied to you. Free was accurate, it just never specified free for whom. Okay, so you're thinking, fine, Nick, I'll hold almost no cash, I'll never trade. I'll buy one broad index fund and hold it until I'm dead. Which is sincerely the correct answer. I am not being sarcastic. That is the winning move. Except the index didn't sit still while you were being disciplined. At the end of 2025, the 10 largest companies in the S&P 500 made up about 41% of the entire index. Some readings in 2026 put it above 43. For scale, at the absolute peak of the dot-com bubble, the event we use as cultural shorthand for the market losing its mind, that figure was under 27%. In 1990, it was around 19. So when you buy a fund holding 500 companies, roughly 40 cents of every dollar lands in about 10 of them. Nvidia around 7%. Apple just behind it. Alphabet a little under that. Asset management estimates the index's effective number of members has fallen below 10% of its actual count, a 15-year low. You own 500 companies the way a fruit salad with one strawberry in it contains strawberries, and Jonathan's cheap plan does not rescue him here, which is the part people miss. Cheap access to a concentrated index is still a concentrated index. He's just getting a discount on the same bet. Now you're thinking, okay, this is the bubble talk everybody does, and you are right to be suspicious of it, so let me steelman it properly. Those 10 companies now produce about a third of the index's total earnings, up from roughly a sixth in 2015. That is not a mania, that is market value tracking actual profit. These businesses genuinely are that dominant. But the price of admission moved. The Shiller-Cape ratio, a valuation measure that smooths earnings across 10 years, currently sits around 40. The long-run average lands somewhere between 17 and 32, depending on who you ask. Historically, buying in at this neighborhood has been followed by weaker 10-year returns. That's odds, not a schedule. Anybody who used Cape to exit the market since 2014 has been spectacularly, expensively wrong, and they have had a full decade to sit in cash and think about it. So the honest version is this: you did exactly what you were told. Buy the whole market, don't pick stocks. And the whole market quietly became a bet on 10 companies, priced every day by institutions holding satellite imagery of the parking lots and credit card data you will never be allowed to buy. And here I want to stop doing arithmetic for a second, because there's a number underneath all of this that explains the shape of everything. The Federal Reserve tracks who actually owns American corporate equity. As of the end of 2025, the top 1% of US households own 50.2% of all corporate equities and mutual fund shares. 50%. Let me say that again. 1% of households own half of the stock market. The top 10% own roughly 87% of it. The bottom half of this entire country owns about 1%. That is not a moral failing distributed evenly across 160 million people. That is an ownership structure. And it is recent. In 1975, private sector pensions had 27 million active participants, and 401k style plans had 11 million. By 2023, those numbers had swapped, and then some. 11 million left in pensions, 96 million in 401ks. Sit with that for a second. Inside one working lifetime, we took market risk, longevity risk, and portfolio management, 3 jobs previously handled by institutions with actual actuaries on staff, and we moved all 3 onto your desk. We didn't train you. We didn't pay you for it. We slid it into your responsibilities somewhere between the dental plan and the parking pass and wished you luck. And I want to describe what that actually feels like, because a statistic won't. It isn't dramatic. Nobody goes bankrupt. It looks like being 61, opening a retirement calculator on a Sunday night with the TV still going, typing in 65, looking at the number, and then quietly typing 67 instead, just to see. And the number gets better. So you leave it there. It looks like the median 401k balance in this country being $44,000. Not the average, the median. The person standing exactly in the middle. At a 4% withdrawal, that is $147 a month. Rent is not $147 a month. It looks like a coworker taking the early package and you sitting in the parking lot afterward doing arithmetic on your phone. It looks like 6% of people taking a hardship withdrawal last year, triple the rate before the pandemic, every one of them knowing exactly what it costs and doing it anyway because the alternative was worse. And then somebody makes a video about how they should have skipped the coffee. That's the real cost, not a chart, a retirement date that slides 1 year further away every year, and you are the only person in the building who notices. If this is the kind of breakdown you want more of, the structural stuff rather than the skip your morning coffee stuff, I run a school community where we go considerably deeper on exactly this. The link is below, it costs nothing, and I genuinely like you in there. Now let's talk about Preston. Preston is 31. Same market, same year, same broad index fund sitting at the core of his portfolio. What's different is what he is permitted to buy. In 1982, the SEC wrote a rule defining an accredited investor. $200,000 in income, $300,000 joint, or $1 million in net worth excluding your house. Clear those bars and you may invest in private companies. Fail to clear them and you are protected from it. Those thresholds have never been adjusted for inflation, not once in over 40 years. In 1983, under 2% of American households qualified. By 2022, 18.5%. 24 million households. The gate never opened. Inflation just quietly rotted the fence, and Preston walked through the hole. So Preston gets pre-IPO allocations, and that matters far more now than it used to, because of where returns actually happen. Jay Ritter at the University of Florida has tracked every American IPO since 1980. Median company age at listing in the 80s, 8 years. Now 12 to 13. Companies spend their entire explosive decade private. By the time you are legally allowed to buy in, the growth curve you were told to capture already happened in rooms you were never permitted to enter. And notice that Jonathan isn't in those rooms either. His cheap plan bought him a better seat in the same waiting area, and on the day it finally goes public, the average first-day pop since 1980 has been about 19%. That pop belongs to whoever got an allocation at the offer price. You buy at the open, which is to say after the jump. Ritter puts the cumulative total left on the table at around $250 billion. Then there's tax, and this is the one that really gets me. You sell a position carrying $70,000 of gains and hand the IRS, about $14,000 at the long-term rate. Preston doesn't sell, he borrows against the identical position instead. A securities-backed line of credit at around 6.5% costs him roughly $9,000 over 2 years, and he keeps every dollar of future appreciation on the whole position. The catch is that these generally want about $500,000 in pledged collateral just to play. Preston pays less than your tax bill and keeps the asset. Then he dies, his heirs receive a stepped-up cost basis, and the gain is never taxed at all. It has a name in tax circles, buy, borrow, die, which sounds like a Jason Statham movie and is somehow considerably more profitable. Same market. Same index. You and Jonathan were arguing over basis points. Preston was operating in a different tax code. The difference between the three of you is not intelligence, or discipline, or risk tolerance. It is that a rule written in 1982 decided which of you was sophisticated enough to be trusted with your own money. Now, you might be thinking, sure, Nick, but retail investors underperform because they behave badly. And there is data for that. Morningstar finds the average dollar invested in a fund earned about 7% a year, while the funds themselves returned 8.2%, a gap worth roughly 15% of your total returns. Except a 2024 academic paper reran Morningstar's own sample and found the real cost of poor timing was about 0.1% per year, not 1.2%. Most of that so-called gap is simply the mechanics of contributing steadily into a rising market. Morningstar itself concedes the cause is debatable. So the story where you're falling behind because you're an idiot is, at absolute minimum, heavily overbilled. What is not overbilled is what gets sold to you. Zero-day options, contracts that expire the same day you buy them, are now roughly 60% of all S&P 500 options volume. Before 2020, 10 to 20%, retail is over half that flow. In India, where the regulator actually published the numbers, 91% of retail derivatives traders lost money in a single year, dropping about $22 billion between them. Massachusetts fined Robinhood $7.5 million and forced it to strip the gamified design out of the app. FINRA fined it $70 million. The largest penalty in that organization's history. 38% of the new brokerage accounts opened in 2020 belong to first-time investors. Nobody has ever built a confetti animation for the guy who buys one index fund a month. And the newest chapter is already underway. In August of 2025, an executive order directed regulators to open 401k plans to private equity, private credit, and digital assets. The Department of Labor proposed the enabling rule in March of 2026. High fees, no liquidity, self-reported valuations, coming soon to a plan menu near you. So let me land this somewhere useful, because I don't think despair is the takeaway. You have never had better tools. Not decent tools, the best in recorded history. 0 commissions, 3 basis point index funds, no account minimums, fractional shares, and the performance data is genuinely on your side. S&P's Spiva scorecard found that in 2025, 79% of active large cap funds lost to the index. Over 15 years, there is not a single one of 22 US equity fund categories where most active managers beat their benchmark. Not one category. Not one. You already own the winning strategy. It's free, it's boring, and it takes about 11 minutes to set up. It is, and I mean this as the highest possible compliment, the least interesting thing you will ever do with money. Which means the real problem was never that the game is unwinnable. It's that nearly every commercial force you encounter is engineered to talk you off the one move that works and into options, active funds, idle cash, private alternatives, whatever pays the person showing it to you. So if you have been sitting there quietly running the arithmetic on yourself while you watch this, stop. You are not behind because you lack discipline. You are behind because you were handed a plan you didn't choose, an app that monetizes your inattention, an index that quietly concentrated while you held it, and a rulebook from 1982 that decided which side of the door you stand on. 4 things. You picked none of them. And I'm obligated to say this, and I mean it. I am not a financial advisor. This is not financial advice. This is educational. Your situation is yours. So here's what I would actually do with all of this. The 4 layers are not equally fixable. You cannot rewrite the accredited investor rule this afternoon. You cannot unconcentrate the S&P 500, and Preston is not giving back the pre-IPO allocation, but you can find out precisely what your plan costs. It lives in a document called the 404 fee disclosure. Your HR department already has it, and almost nobody in the history of that department has ever asked to see it. And you can find out what your broker pays you on idle cash and move it if the answer is insulting. Those 2 phone calls will out-earn every stock pick you make this decade. That isn't motivational, that's just the $159,000 from earlier showing up as a to-do list. And if you'd like people doing that alongside you, our school community is sitting right there in the description. But the question I'd carry out of this one is simpler. And it works on literally any financial product for the rest of your life. Who gets paid when I do this? And would they still be standing here if I did the boring thing instead? Because everything you just watched is downstream of that one answer.